Socially responsible investors are increasingly looking to make a profit while doing good. But can you make a difference without sacrificing return? Impact investors say yes. The Dubai-based private equity firm Willow Impacting Investments is close to closing an $80 million fund and recently completed its first project, a value-added dairy company in Kenya. Here to talk about it are Willow founders Pasha Bakhtiar and Nadine Kettaneh. Pasha, Nadine, welcome to INSEAD Knowledge.
Thank you.
A recent study supported by Willow suggests that impact investors in emerging markets are looking to get a return of between 20 and 24% on their investments. Is this a typical return, and what are you offering for this investment?
We are usually longer term investors, so when we make an investment, it's going to take at least 5 years to realize what type of returns we're actually generating. But you know, in conclusion, I think that it's fair to assume that the 20% IRR mark is not going to be far from the reality.
And of course, we're promising impactful returns. So this is really the difference. We will measure and report the various impacts that we have and be able to liaise directly with our investors to explain how their investment is being put to use, how their capital is being put to use, and what positive impacts it's generating.
Your first project, Bio, is supporting rural farmers and landholders in Kenya. There must be dozens or perhaps hundreds of similar worthy causes out there. How did you decide on this project?
It's a beautifully run company. It has very high standards of environmental and social code of conduct. It has very strong governance. It has a very strong reputation for quality. It's a great brand. It's an award-winning brand. All its products, its processes, its ethos, if you like, make it really an outstanding SME in Kenya. And we had huge confidence in the management and its potential to deliver on the growth that it is looking for, and on its potential to deliver on the impact that we're both looking for. And there's a certain alignment of interests and objectives with the management of that company.
When you're operating in the space we operate in, you tend to find that the social impact and or the environmental impact is fully enmeshed in the DNA of the company. I think that, you know, a lot of the businesses we look at naturally are I think focused on not only generating a financial return, but are very aware of the necessity to create jobs, to train people, to have better working conditions, to you know, provide a product which is of higher quality and which is affordable to a segment of society which perhaps didn't have access to what in essence we consider to be basic goods and services.
I'm guessing that different investors have very different ideas about how they rate financial against social returns. Have you had to be very clear and set out your goals from the beginning?
I think you have to be clear. You have to be clear that, you know, we're looking at this from a different angle. We want to cover both bases, but what is also crystal clear is that there is no trade-off. It's not just because we're trying to generate social impact, or, you know, we're generating social impact or environmental impact in our investments, that we're foregoing X% of financial return. That trade-off does not exist. And a lot of people look for it. It doesn't exist. A lot of people will come to us and say, okay, you guys are generating impact, you know, how much return are you willing to forego to generate that impact? You know, from, I think, the standpoint of someone who's sitting in an office with a matrix, that may make sense. But from the standpoint of people who've been on the ground and who are doing it, it doesn't exist. We sit down with real businesses, we do real investments, and we realize that the reality of it is both of them exist hand in hand if you invest in the right businesses.
How long before your investors see a return on their money?
As you were saying, it's not difficult to generate the alignment of profit and generation of impact. Measurement and assessment of impact is quite a new industry, if you like, or quite a new experience that private equity investors and impact investors especially are adopting. There are a number of systems out there. So one of them is called IRIS, the Impact Reporting and Investment Standards, which we have adopted. that basically gives you a very big list of all the potential impacts that you can create. So once you've identified those, you start gathering data and measuring and tracking through the length of the investment and the period of the investment, what impacts you're generating and how well you're doing there. And that is, it's a system that is very well accepted, that you can adopt and report on to your investors.
Geographically, where's Willow's focus and in what sectors?
No specific sectors other than the impact sectors which Nadine can talk about, but geographically it's East Africa and the MENA, so MENA, Middle East, North Africa, Sub-Saharan East Africa from Ethiopia all the way down to Mozambique.
The countries you're looking at are considered to be pretty risky, both politically and economically. What plans do you have for managing this risk?
The political and economic risk in a lot of these countries is, in our opinion, somewhat overblown. I think if you look at the maturity of the markets, such as, let's take a country such as Kenya or Uganda or even Mozambique, a lot of these regulatory environments have matured dramatically over the past decade and have become very open to foreign investment. They have become cognizant of the fact that they need to attract foreign investment increasingly in order to be successful at growing their economy the way they want to grow it. But you're never going to be able to eliminate political or country risk altogether. And I think that it can be just as risky investing in a European market as it could be in an African market. Our risk and our approach to risk is very much centered on the business into which we're investing. And we do invest in countries where there's obviously a free flow of capital. Obviously you can repatriate profits. Obviously there is a currency risk of depreciation. There is an inflation risk in terms of macroeconomics, but these are risks which you find everywhere.
What other challenges are in these markets in regards to corruption, infrastructure or transport?
Lack of infrastructure, definitely.
Yes.
Yeah. Lack of infrastructure, definitely, and I think that's also, when you spend time down there, you realize the huge efforts being put in place to build roads, to build interchanges, to build tunnels, to build bridges, to build mobile antenna networks. There is a lot being done. To answer your question on corruption, again, I would say that there's corruption everywhere. And we obviously don't work and don't invest in businesses that engage in that type of practice. Not that they would disclose it to us during the due diligence process anyway, but we have a process which enables us to go deep enough to figure out what's going on. And again, the SME segment is not traditionally a segment in which you would find widespread use of corruption. It's very generally found in the kind of larger semi-state-owned type institutions, which again, I think that's evolving, and you're not seeing it as much as you used to.
The Monitor Institute estimates that impact investments will be worth 500 billion by 2020. Do you see the sector as being a major contributor to the development of emerging nations?
Absolutely, because it's because it is investing responsibly. And it will help the development of all these nations, not only economically, but also in terms of bringing up social practices, employment practices, sound governance practices, at every single level that a country should be developing economically.
It's becoming a more recognized asset class, I think, with the generational shift in terms of the people who control assets. You're finding a desire to be more exposed to an asset class where you have an understanding and a vision as to what your capital is doing and achieving, as opposed to investing in some obscure structured notes. What we're seeing now with this newer generation, be it young entrepreneurs who have succeeded by themselves, or be it younger generation who are coming into wealth because they're inheriting it or because they're being given part of it by parents who have made it, they are investing differently. They want to invest responsibly. As Nadine was saying, I think that That's from the investor side. From the business side, people are realizing that if they want to attract investors, they need to have sound governance, they need to be more transparent. There is no other way in which we see the financial world evolving. I think that people from Bill Gates to Warren Buffett to Jeffrey Sachs are all advocating the need for a more creative and innovative form of capitalism.
Pasha, Nadine, thanks for being with us on INSEAD Knowledge.
Thank you.
It's a pleasure.